The stock market hit all-time highs. As Lacalle.
Well, I think that what's happening is that the disconnect between markets, particularly equity markets and the riskier bonds, and the real economy, has reached levels that we have not seen in decades. And this is very concerning because it seems that there is a mentality among market participants that sort of thinks that if the economy is not doing well, we must buy the more risky assets because the Federal Reserve and other central banks are going to inject masses of liquidity. And if the economy is recovering, we have to be bullish. So it's almost a double bet on everything is positive for risk. And as we all know, risk builds slowly and happens very fast. So I think that many economists and a rising number of brokers as well are highlighting the risk of a massive disconnect between the real economy and equity markets and obviously bond markets, because at some point that can create a big negative effect that could translate either in a financial crisis or in a big correction that ends up generating ripple effects into the real economy.
So the gravy train, it can't keep running like this, right?
Absolutely. I think that there's a perverse incentive among market participants to take massive levels of risk based on the idea that central banks are always going to support markets with commoditive policies, which is correct, but it doesn't alter the fact that the central banks don't eliminate risk. They might disguise it for a little while, but they don't eliminate it. And there's a big risk that once that level of excessive optimism and exuberance in equity markets reaches breakup points, then generates a problem in the banking sector, and that creates ripple effects in the real economy.
And the Fed were quite pessimistic on the European Union as well, despite all of the work by the European Central Bank, right?
Yeah, the European Central Bank's balance sheet has risen to 61% of the GDP of the Eurozone, which just for comparison purposes, the Fed's balance sheet is 34% of the GDP of the United States. So it's a massive increase in the balance sheet of the European Central Bank, huge fiscal support from governments, but the lockdowns that we have seen in the second part of the second half of the year are generating a much bigger impact on the economy than what central banks and governments expected. And the economy started to show very significant levels of weakness already in September, despite masses of liquidity injection. And these new lockdowns happen at a time in which the economy was already on its knees. So the negative effects are likely to be seen at least into the first quarter of 2021.
And here in the States, are you expecting just much of the same from the Fed, or any change in strategy?
Well, obviously, it all depends on whether the United States follows the aggressive lockdowns that some European countries have implemented to attack the coronavirus. I think that by now we should all be at least aware of the fact that lockdowns destroy the economy and have a much larger impact on the economy than governments think of in the first place, and that the impact on the health situation is not very relevant, because by the time that governments implement lockdowns, the problem has already been generated. So it's almost like once a car crashes, the driver says, "Oh, I should slow down." No, I think that what the United States is doing, which is to provide protocols and strict measures to allow the business fabric to continue to survive, at least in a difficult environment, is crucial in order to avoid a situation like what we've seen in the European Union, in which the healthcare crisis has not been prevented and the economic impact has been much more severe.
Appreciate the analysis, Daniel. Happy Thanksgiving. Talk soon.
Happy Thanksgiving to everyone. Thank you very much.